Hey y'all, this is Latoya Paul, and today I want to help you guys with trading as usual. Today we're going to figure out a few things. As we continue from the previous video that I posted a few days ago, we understand that supply and demand works with support and resistance. You can't have one without the other. Supply and demand happens every day. Every day of the week, there must be supply and demand. Okay. Now, how do you decide? How do we decide which side of the chart or a side of the coin? Because there's only two sides of the coin: supply or demand. How do we decide which one we should be taking? Well, the thing I like about the market is that if you let it, it will show you. It doesn't matter where you are. It doesn't matter what time of day. It'll show you, right? If you don't see it, it's because it's not there. Okay, so. Let's look at it. I'm gonna look at December 26th through today. Okay, so let's look at December 26th. All right. So let me zoom in a little bit. We can be zoomed in. Now, per the last video, when highs are broken by demand, that high becomes support on the other side of a demand move. Okay, demand and support work in tandem. All right, this is what we do. All right, because most people we got a lot of information. We got multiple ways to do the same thing. Now, how do we do this? How do we bring it to life? Now, the first thing I want to say is the easy way. When you don't know, wait for a move. When you don't know, like for example, you don't know if it's going to continue down or up. Right here, right? Have no idea. Most people would assume that because it came and retested the moving average, that it will continue down. I've done it before. When you don't know, you wait. It's better to be patient and wait than to assume and wake up to some money loss or money in the red. Right? Now you got to figure your whole strategy changes because your emotions are involved. It's better to be patient. Like it's people, for example, driving. Some people will wait until traffic is perfectly clear before they merge or enter into the highway. When it comes to trading, I definitely suggest waiting. Okay, if you don't know, it's better to wait. Now we have a demand move here. Now this demand move went above this area right here. This was resistance at some point. We see wicks at the top. Wicks at the top on the smaller time frames mean price was pushing down. All right. Then price pushed up. Now this resistance on the right side of the demand, it turns into support. All right. Now here's a cool thing about these moves. Once you get price coming back to this area, how do you enter? Well, you enter and you use the previous low as your stop loss. Now here's a cool thing about this. We would say 200 pips. That's a lot of pips. Well, you had about 1, 2, 3, 4, 5, 6, 7, about 2 hours to see how far this move was to appropriate your lot size for this entry for the buy so that this 200 pip window won't scare you. All right. So how do you make room for 200 pips? Make sure that your lot size is 300 pips. Or something, make sure that whatever your lot size is, it can handle a 200 pip drawdown. God forbid this comes down. We don't control the markets. We just take great educational guesses as to what we believe the market's going to do. All right. So if you got $100, why chance taking this trade with $1? You don't have 200 pips of move or 200 pips of play. You definitely risk a margin call, right? Even the 0.05, which is 200 pips divided by 100, the 50-cent trade, you break it, you're putting yourself in the red. Now, can you afford a 20-cent trade or a 30-cent trade, which is a 0.02 or a 0.03? Yes, you can afford to take a $40 risk or a $60 risk because the goal is to be correct on the trade. Okay, now if you, let's say for instance you took that 0.03 here and put your stop loss here, it's a more comfortable trade right? And you would have made 150 bucks, right? So instead of saying, well, that could have been 500, but you don't look at what you could have done if the positioning to make that is bad, is a bad habit. Don't even look at, oh, I could have made $500. I could have made $450 today off the $100 if the cost of that was not one that you can replay and redo to produce the same result. Okay, so let's just say this trade produced 450 pips at 30 cents, right? Or 500 pips at 30 cents. That's $150. That's growth. It's not just growth to your account, but it's growth in the sense that the practice was healthy. All right, healthy practice. Okay, now we still got pushes to the high. All right, nothing was major. As we come to the end of the day, we did have some lower highs and lower lows. Where this was a lower low, it broke this point, but it didn't come lower than this. All right, so we wait. Now coming to the new day, what do we see? We see a major supply break that broke beneath all the movement of the previous day. We gotta recognize that. So what do? We look at this low, right? And even this low, right, as a window, right? That's the window. Now, price pushed down. We had 1, 2, 3, 4, what, an hour, 2-3 hours, because price played right here to make it to look and see how much of space we would need to have. Now, mind you, we just made 150 bucks the day prior, so our account is at 250. All right, we have $250 in our account. We're trading gold. We know that gold is very volatile, but we're not focusing on how volatile gold is. We're focusing on how to make the best decision for where we are with our capital. All right, so we look at this. We say, okay, if we get in at the first point, the previous high is here. So that's 200 pips of drawdown that we have to be aware of. Okay, if we get in here, that's still about 200 pips that we have to be aware of. So what could we do? What trade size could we take or could we enter that won't put our account in the red? Even if we get stopped out, what could we do? All right, we know 0.1 is off limits. That's instant margin call. Right, 0.05 is a better option. That's like 500 pips away. We don't need that much play. All right, but could we do maybe a 0.04? A 0.04 is 80. That's $80. Okay, so we're risking $80 to make whatever the market will give us off this move. All right, so we see that if we enter in at that first pip, we're still doing a 200 pip drawdown. So we're risking 80 bucks to make what this move made. This is just trading once. We're not trading multiple times within the day. We're just taking this one trade for the extent of the move. All right. So this 0.04 down to here, that's 1900 pips, which could have been 2000. Right. Let's say, for instance, we caught the 2000. So that's 0.04 of 2000. That's $800. So we risk $80 to make $800, right? So now our account is at 1,050. This is 2 days in, and we're just looking for. We're not forcing anything. If we don't see it, we don't trade. Okay. Now we're coming into the third day. We have pushes to the top. We have one push to the top, which could have been okay. That's not major, but then we had this push, right? This demand. We had a demand move here because this was the high. It broke this high and gave us this little push, came down. Then we had this demand move. So now we're looking at this. We have support. Resistance turned into support right here. This was resistance prior to this demand move. Price pushed down, which confirmed that it was resistance because we have supply. Whenever there's resistance, you must have supply to confirm that it was resistance. Whenever there is support, you must have demand to confirm that this is support, right? So we had this demand move here, pushed up. We had it go up here, right? Now we had about 45 minutes to decide what we wanted to do, right? Now, if we missed all this move and we had to come back down, we know that we had about 200 to 250 pips of space because of gold's volatility. Right now we're at $1,000 in our account. Right now if we go with the point, we can't do 0.5 because that's in that margin call area. Right, we can do a 0.3 would be risking $600, which is defeating the purpose of having $1,000. We can't risk no more than $400, right? So $400, we're talking about anywhere between $1.50 to $2 a pip, which we can do $2 a pip. So we come in here with point two. We come here with point two. We put our stop loss here, right? Let me see here. Delete this. We put our stop loss here, right? And so what we do is we go to the high. We go to the high, or at least until we get a breakup structure, which we had here, or until we satisfy it. Honestly, because if this is 200 pips of movement, just going to here is more than enough. That's 300 pips, right? That's enough. Or we could say, okay, we got this. Let's say we can get a little higher. Price breaks this. We had a little bit of demand move, break retest, and it starts to slow down here, right? That's 450 pips. So 450 pips at $2 a pip is $900. So the account is at $1950, and we started off with $100, y'all. $100 on December 26th. Okay, now we're in December 30th still, and we're at 1950. But the goal was not. So we're benefiting from the volatility of gold, not by just trading, but by looking at what we have coupled with what has been given as far as data, and deciding based on the data what we can risk with what's been given, using supply and demand and support and resistance. Obviously, let me make sure it's not support and demand and supply and resistance. I'll say that again. Support, demand and support, and supply and resistance. You have to keep them together. We can't keep saying support and demand, and we can't keep saying supply and demand and support and resistance, because we don't see the separation of the of the four entities. We don't see how which one should be together, which one should be together, which one shouldn't be together. So like I said before, we're looking at demand that creates support, and we're looking at supply that creates resistance. Those two work in tandem. All right. Now we're still on December 30th. All right. We're at the high of the day. We got a high. We got a break of structure here. Well, we want to see it. We got to see at least another break to confirm that it's going down. All right. We know this. We had a big move the day prior, but we don't want to just assume that because we have this break that it's going to continue to go down, because we've seen it where it'll come down and continue to go back up. So we're going to just take what's been given, right? We have this high, this was broken, we had a low here and another high. This pushed down, okay? This gave us another push. We got another level of supply, another supply move that created what? The support turned into resistance. Support on the left side of the supply turns into resistance, okay? Now, let's look at how much time we have, because we're using the previous level, and that's why it's good to wait for a second push, because you can see where you can set your stop loss for one. All right, even if this first one, if you want to say that, you can set your stop loss here. Right, everything is a chance you're taking, but it's an educated guess based on with the data we've been given. We're not thinking beyond what's being shown to us, because it's there for a reason. These are data points. We don't want to ignore the data and think we can make money emotionally. Okay, so we have 1, 2, 3, 4, 5, 6, 7, 8, 9. 9 times 15. So we got about 2 hours and 15 minutes to see what we're going to do. We're looking at this previous high as our stop loss level. All right, we have $1,950. Let's see how much space this is between this high and this level that we're looking to enter in once it comes back. All right, so how much space is this? About 120 pips. So 120 pips, we have 1950. Okay, we know for sure we're not risking anything within that 200 pip window. So we're not risking um, a standard lot, which is $10. Okay, we may be able to do the point 0.5 finally because that's about 400 pips away. All right, but we know for sure that we got 120 pips, 100 to 120 pips of drawdown that may occur, and we have to be able to take a trade that if we were to get stopped out, we can handle that, and we'll still have capital left over to recoup those losses at a better opportunity. So we're going to go with the point 0.5 here. We're going with the point 0.5 here, and we're going to go down till it slows down. That's to say the end of the day, to keep our growth safe, to be able to call it a day and come back to the market after the spread hour and see what else is being given. So we go from here down to here. That's 400 pips. So 0.5 times 400. That's $5 a pip times 400. We're at 2,000. That's 2,000 within 2,900 within that third day, putting our account at 3,950. And remind you, this is only the third day of trading. The first day we started off with $100, and we made our decisions based on what has been given. Okay, so we come back into the next day. What do we see? First of all, we got to make sure that we don't want to overlook this level, because this level was obviously blown through by the last demand move, the last supply move of the day. So we don't want to overlook that. All right, we don't want to overlook that because that's an opportunity for the next day if price comes back up to that level. Right now, we're using the previous high as a place as to where we can put our stop loss. Right now, you have a couple options. Now, some people would do it tight. Tight would have been stopped out. I'm looking at this level as the stop loss radius, and the reason why I say that is because that's where the last move took place. Now, it's still a chance because price can come back to previous levels of supply to retest supply, but that's the chance that we're willing to take because that's the greatest possible area that we can look at. Now, also, let me make sure to keep this clear, right? We also have this as well. We don't want to overlook the small things, all right? Because we can say this is actually a better entry for the retest because it reduces the drawdown that we could adhere, right? So let me clean this up, push it up a little higher. Gotta get ready to go in a minute. All right, so we look at this. We have this low, and I'm gonna put it on the body. I like using the body of the candle. The body of the candle, body. And these lines are not straight. There you go. So we have this low and this low. Preferably this low will be better. I want to put it, keep saying, I want this to be on the body. So I'm putting this on the body of the candle that was broken, or the candles. Okay, so this low was broken. We had this this slim minor high, then it dropped through. So we have a range of between 200 to 150 to 200 pips of drawdown, possibly. All right, now this is what we've been doing, and this is okay because that is the area that we've been this is the goal with the move. This video is to help master our management. That way we can benefit from the market. If you don't master your management, you will not be able to benefit from all this volatility. People fear the volatile market because they don't know how to manage their risk on their end. That the only thing you can control is what you put out, right? But that control must be gauged by what the market is showing. All right, so we got 140 to 200 pips of drawdown possibly, but we want to use this space as an area for entry. Now, we could say we didn't have this. This came in and didn't close above, but we can use this closing candle as an indication as to where we can possibly look to enter. All right, so let's say, for instance, you just had it here. You enter once it hit here, right? Before we get there, Like I said, we had about a few hours to let this come down and go up. We have to see how much we're willing to set aside out of this 39.50. We know we're not doing anything in that 200 pip range, so we can't do $20 a pip yet. But the goal is to grow that. We can do. It's not. Here's the thing: we don't want to risk anything that puts our account beneath 2,000, right? So at this point, we can't risk the $10 a pip yet, because if that was to get hit, that'll cut our account in half. So let's see what we can do. Could we do? We can do $8 a pip. $8 a pip is only risking 1,600. If we were to lose 1,600, we'll still have $2,350 left. So we're going to do $8 a pip, but at this level right here, right? So we put here and we go down. It hits this low. It gives us about 30 minutes to see it hits this low. Now, these wicks on the smaller time frames are the M's and W's that we normally look for. All right, so it hits this low, it comes back up and comes down. We could say we got on the 800. So we risked for 140, which is 140 times 8. That's $1,120 to make 6,400 with this 800 pip move, right? So the fourth day, risking a point eight, we risked $1,120 and made 6,400, putting our account at over 10 grand, 10,350. Now this is the benefit of using our risk management to benefit from a volatile market. Now this I'm meant to show you all these things to give you a strategy for entry, a strategy for entry, a strategy for exit. Now you exit as you see put. Some folks exit here, which to each his own, but the entry is the most important thing, because if your entry is wrong, you won't have an exit. You'll be stopped out, you'll be margin called, and then if you're afraid of volatility, it's not because of the volatility of the market. It's because you don't know how to manage what you have, like I've been going over, to benefit from the volatility, right? That's the only thing. So we got the 800, and what else do we have? We had a break of a low, right? Break of a low, and we had all this time, 1, 2, 3, 4, 5, 6, about an hour and a half, right? What did we do? Look at that previous high as our stop loss. That's it. Break of structure by supply, meaning that we should be looking for this opportunity here. Put our previous high as a stop loss and see where it goes. Okay. Now, we had about an hour and a half to see what this is. This is 100 pips. Okay. Now we had $10,000. 100 pips. We don't want to put the account at 5,000. So we can't do $50 a pip. But we can do $20. We can do $20 to $30 a pip. We can risk $2,000 to $3,000 of that and still have $7,000 to $8,000 left if we take a loss. So what we're going to do is we do the two standards, which is $20 a pip, right? We're risking $2,000. This comes down, right? Now you may not have gotten out here, right? But if it comes back to this point, you get out. So $20 at 240 pips, that's $4,800. Okay, and now mind you, this is all still in that fourth day. So this is actually you should be trying to go crazy. You should be trying to figure out how to make this your last trade, because you already made $6,400 a move prior. So $4,800 plus 10,350, that's $15,150 on the fourth day. This is 4 days in. 4 days in. Okay. Now we call it a day. This is the end of this is New Year's Eve. All right. Now we do mark up our charts. We have a possible, we got here. Actually, no, we wait. We don't mark it up until we come back. All right. Now price pushes up January 2nd, this past Friday. Price pushes up and goes up there. We mark our charts. We have this resistance turn into supply over here. Nothing showed up. Price went up higher. We got this resistance turned into support over here. Okay. Now, what do? All right. We can do two things. We can look at the gap between these two, or we can go to the previous low, which would be this one, and say, okay, we're going to use this one for the sake of possibly the market possibly coming back and doing a fair value gap fill. We're going to just be safe because that's how we've been doing it so far. We've been safe, right? So how much? So we had all this time. It hit this and then it started to range. We had demand. We had demand. We had about 2 hours to decide what we were going to do because we had resistance turn into support, right? And we had how much? About 150 pips of drawdown possibly for our stop loss. Now we're at 15,000. We don't want to risk any. We don't want to put our account at 8,000. So we're not risking anything. Let's just make it an even 200 pips of drawdown for the sake of numbers. We're not going to risk. We're not going to have our stop loss or our lot size be anything 40. So we're not risking $40 a pip. All right. So we got 200 pips of drawdown. Right. We don't want the account to be less than 10,000. We got 5,000 to play with. Okay. So 5,000 divided by 200, that's $25 a pip. So we take this trade with $25 a pip and we see where it goes. Okay. We had this. We had 1, 2, 3. Most time that third time, unless there's a trend extension, the market tends to go the other way. Plus, that's 500 pips. Who would be greedy with who just made 10,000 off? You risked 5,000 and you made 10,000. Actually, more. Forgive me. You made 12,500 because 25 times 500 is 12,500. So we getting out of that trade at 500. Like, come on, we already up. We winning. All right. So this is the fifth day. We take a $25 trade, risking 5,000 if the stop loss is hit to make 12,500. Our account is at 27,650 6 days in. Okay. Now we still got some stuff that we can look at. We have a break, a major supply move here, right? So this was broken. A lot of lows was broken. This was broken. All right, this one was broken. Put it on our body. It's on the body. All right, we had that break come down. Like I said, if you wanted to take that trade, you will only have to. You will be mindful of that's your window. All right. Now we some people wait to the second one. Sometimes the second one doesn't show, but it's definitely there on the smaller time frame. But let's say, for instance, we decided to take this trade. We have 27,000. We don't want the account to go beneath, let's say 20. So we're risking 7,000. That's our risk. So 7,000, and we're going to just keep it at that's 100. And let's say for the sake of numbers, we're going to do a 200 pip stop loss for whatever this point is. So 200 pips is it's like up here. So our stop loss will be right here. That's just for the sake of keeping the numbers, right? This our stop loss. This is our entry. We're risking 7,000. So 7,000 divided by 200 is 35. Right? 35. Enter here. Price comes to here. Give us another low push down here. So that's from you could have made anywhere between 500 and 600 pips. So let's say, for instance, we got out at the 600 pip mark. That 35 times $600 is 21,000. Right? So 21,000. 5 days prior, we started off with 100. So I'm gonna stop the video here because I got to get to consecration. But 48,650, we were able to benefit from the move in the volatile market because we took what was given from the data and the price points, and we managed our risk well. That's all we did. Okay. So when I'm gonna say this, I'm gonna stop this video. And then I'm going to upload it to the page, to my YouTube channel, and then to my Facebook page. It's going to be how do we benefiting from a volatile market through risk management. I'm going to title this Benefiting from a Volatile Market Through Proper Risk Management. All right, you guys have a great day, and I'll see you If not this week, sometime whenever I get some more information to put on this channel. All right, have a good one.